Today, we have for our professional education is going to be Philanthropic Giving, Faces of Charitable Giving, and presented by Peggy Farnworth. Peggy's bio here. Peggy Farnworth is a financial advisor and retirement coach in Boise, Idaho. She holds credentials as a CPA, CFP, and CSA. Peggy has a Bachelor of Science degree in accounting from Boise State University. In her 30-plus years serving clients here in and around the Treasure Valley, Peggy is known for her integrity, creativity, and compassion. Her keen ability to address complex situations and her client-centered approach results in unique financial plans that are tailored to each individual's lifestyle and goals. She works diligently to create a sense of financial health and happiness that enriches each client's life. Peggy, we are honored and welcome you this morning in order to share with us what you do.
You're on mute, Peggy.
I need to get my slide deck up here.
Looks great. And do you want to put it into slideshow mode as well?
That's what I'm waiting for the item to get out of the way.
There we go.
All right. I'm happy to be here. Giving is one of my passions. So I have put some focus and emphasis on ways to give and why to give. So we're hitting in the season whereas the charities can receive up to 50% of what their donations are for a year. So what are reasons that we would give? This is audience participation.
To support an organization that's either supported us in the past or that we have a passion for.
Yeah, okay. And this, like the person that was just on, she received benefit from the TIP organization and then turned around to volunteer for the TIP organization. Any other experiences in the giving or why you would give or experiences in giving? Okay, I'll help you out. All right, so there are benefits of generosity. One, you're supporting a cause that you believe in, or it builds connections and strengthens the community, which we just saw that as an example with the TIPS scenario, strengthening the community, and the first responders feeling that benefit and support. It improves your mental and physical health. There's studies been done on that. It is pretty awesome. Creates a lasting legacy, and you might be able to reduce your taxable income. So looking at those in a little bit more depth, what do you see for your sense of fulfillment? If you think of a tree, you have the basic components of the roots, the trunk, the leaves. Well, giving to a cause you believe in, reaches your core values and belief. It gives support and purpose and growth and vitality. I know in my volunteering in different organizations, there has been much growth and development. Supporting a cause you believe in can strengthen your own personal values. It fosters community by meeting a need, and it creates that social interaction because you're doing community-focused collaboration. You're working with like-minded people and growing your network. You are participating with partners that are strengthening and supporting the system. And you are, can't see what my needs are there. You are being able to support and help those that are in need, but supporting the situation, making their situation better. What I have found within, as I work with seniors and what has become a critical factor is you need to have that social interaction. You need to have that purpose. And I find volunteering and giving to charities is a good way to make that connection happen. It is life-sustaining in so many different ways. So there's a number of charities that you can give to. I like to have people emphasize their giving in a local area. You have a little bit more ability to go check on what the charities are doing with the money that you support or provide, or you have firsthand knowledge if you're volunteering there, what can be done. And there are ways to evaluate what a charity can, how to work with the charity. So I have a very strong passion for veterans, and I was looking at a couple national organizations to decide what is it that I wanted, who I wanted to support. So I went to Charity Navigator, who evaluates large charities, those that have $1 million or more in receipts kind of contributions. And I took a look at the programs under each one. Now, one program, 95% of their receipts goes into their programs. That's a charity you want to support. The other one had about 70% of their receipts goes into the programs. That's not what you want to be supporting. You want more of your monies to be actually reaching to the program and less of your money being used administratively. If the charity is not super large and is a smaller size, but they have to file a tax return, which you don't have to file a tax return if your receipts are less than 50,000 in a year. But if the charity is filing a tax return, you can go to GuideStar and be able to look up your charity there and take a look at they have a copy of the tax return there. May not be a real current copy, but you can take a look at, so what are you going to look at? I'm an accountant. I know where I would go. So basically you're going to look at what monies were received, what were their sources of those monies received, and then more importantly, where did they spend them? Did they spend them in administration? Did they spend a lot of money in fundraising? Did they spend a lot of money in, or did they spend more of their money on the programs? So it takes a little bit of digging with the GuideStar approach, but if you want to evaluate how your money is being spent, is it a good source? I've worked hard to make my monies. I don't want to put my monies in a leaky bucket. So I want to be sure that the organizations are using my money wisely. So the other fun fact is charity improves your health and mental well-being. It can lower your blood pressure. It can lower your stress factor, reduce anxiety and depression, and extends your lifespan. There's been a number of studies on this particular issue of how much it can help your health benefit. And it increases your feeling of well-being. So happy is healthy. You have pro-social spending increases the production of the happy chemicals. The happy chemicals being endorphins, dopamine, and oxytocin. So your feeling good is a product of doing good. And you might be surprised that Harvard Business School did a study on these benefits and the health factor and the results of that. And they found that there wasn't any difference in depending on what culture you were in or what economic status you were in, these benefits go across the lines. So it kind of gives that proof to the adage that it's better to give than to receive. So another reason for giving is to create a lasting legacy. What kind of impact do you want to have on your community? How do you want to be remembered by friends and family members? And which values do you want to pass on to future generations? So I look at my giving, and I'm very intentional in my giving. In one community I wanted to give to, I I could sponsor a table at the gala and get my advertising and so forth. But I saw a need within the organization, and I went to them and said, "Hey, can you reach out to your board and see if I can give a donation that can be specified to be used on mental health training only?" Because I saw a need within the youth that they all have some kind of mental health issues, some more than others. And most of the staff and volunteers are not really trained in that arena. So I felt that needed to be something we addressed. So that was the impact I wanted to have on that community, is to give them the monies to pay for the training, to that provide the support that their members needed. And how do you want to be remembered by friends and family? I kind of like to have that opportunity to, you go to these funerals and you hear all these flowery things said and find out about things that they were doing behind the scenes. Man, it would be nice to have that knowledge ahead of time. I go to a lot of client funerals, and I'm like, wow, didn't know that about that person. But what do you want that to be shared? What do you want your final remembrance to be? And what do you want to pass on to future generations? How are you going to transfer your values with those dollars? So those are a lot of opportunities within our organization, within the community, to be able to transfer, to embrace creating those opportunities and providing, supporting. So we're going to talk a lot about the strategic ways that we can benefit organizations and their finances, helping them financially. So the easy option is to write a check. And I think that happens a large percentage of the time because we're doing something quick and easy. So we can write that check and send that in. Thank you so much, Dara, for your generosity. Nobody's noticing the check. Okay. And then
I liked it.
I noticed it, and I only wish I could write a check that big.
yeah, okay. The other way that you can give is with your appreciated assets. So when you buy stocks or mutual funds or something along those lines, they can increase in value. And if you were to access those values, you would have capital gains, a taxable consequence in doing so. And that is part of what those three things, or those two things together, becomes that fair market value. Well, you can transfer that investment and turn that into a donation when you give it to the charity. And in that situation, basically, that's a fair market value of the donation. That's what you get as a tax deduction. And your charity pays zero taxes. Charities don't pay taxes in there unless it's on non-related in receipts or income. If they were running a restaurant and it's not that restaurant would be a non-income, non-related business activity. So then you've taken a taxable investment piece, created a donation that you get a tax deduction for. You have no tax consequences for having transferred that out. If you had sold it, taken the cash and given it to the charity, you would have had to pay taxes on that. You pass off that appreciated asset to the charity, and the charity is the one that receives the full benefit of the investment and doesn't pay any taxes on that. It's really a win-win. I have a few clients that's about the only way that they give, is through their appreciated stocks and transferring those to charities. Okay. So estate planning and IRA beneficiaries. So what are you really giving when you have your IRA? Most people leave their child after the spouse. They have a child as a beneficiary on the IRA account. It's really very common. But what are you giving? This actually can be a result of a ticking tax bomb to do that. Because what we have with inherited IRAs is the new 10-year rule that basically came into place in 2019. And it says that if you as a child receive a inheritance or a distribution, an IRA from your parent, then you now, rather than getting to take that out over your life expectancy, you now have to pay that out in a 10-year period by the end of the 10th year following the owner's passing. So you basically just pushed out monies into a tax picture. Now, the key is, what are you actually pushing out the door? And that depends on your circumstances. If you have $1 million and 2 kids, that's $500,000 per kid. 10 years, they have to pay that out. That's $50,000 a year. That's enough to change your tax bracket. You're going to be paying taxes on that. And depending upon what your child is doing, it can be a significant amount of taxes. If you have $1 million account and you have 6 kids, well, that's $250,000 per kid, I think. And you're down to $25,000 per year. That's a more manageable size to be able to handle, to address. So if you have a number of kids, an IRA might be a good option. But if you have small number of kids, which is more like most families today, you really could be leaving them a tax bomb. So what can you do differently? You can make them the beneficiaries of your life insurance instead, and they can receive that tax-free. So have $1 million life insurance policy, the kids receive, and 2 beneficiaries, they get that $500,000, and they are not paying taxes on that. And you can give the IRA monies to charity instead, because they don't pay taxes on it either. So another way to give distributions or monies to charities are QCDs, which are a win-win scenario for you as an IRA owner. So what are QCDs? They are qualified charitable distributions. And who is eligible? The IRA account holder who is over 70 and a half years of age. And it is 70 and a half physical age. It cannot be the year that you turn 70 and a half. You actually have to be over 70 and a half. And how do they work? Well, you make distributions that are payable to the charity, or the custodian of the IRA would make distributions payable to the charity, and that would maintain records of that donation. Most charities will send you a receipt for the donation being made. And the maximum amount that you can contribute started at $100,000 and it's been indexed, and you can do that up to $105,000 for the year 2024. So what is the benefit of giving in this way? Well, there's no itemization required. It reduces the taxable portion of your required minimum distribution. And the contributions also reduce your adjusted gross income. Well, why is the adjusted gross income important? Because it decides a lot of things. AGI is an accumulation of income, such as capital gains and retirement income, and it determines your Medicare premium, or IRMA. And IRMA stands for the Related Monthly Income Adjustment Amount, calculated using your modified AGI, which is your AGI plus tax-exempt interest. So, and what that does is you have a threshold. Yes, you have a base cost to your Medicare premium, but then it is also evaluated according to what your AGI income is. And so each tier, there's like 4 or 5 tiers. For singles, I think you get up to about $105,000, and at this point in time for your 2024 income can be under the 105, and there would be no impact on your 2026 Medicare premium. There's a 2-year lag between your what your AGI is and what year is going to impact your IRMA. Your Medicare premium. I watched the 2024 year because that's what you need to have. That's what you're managing for the 2026 Medicare premium. And there are multiple tiers, and you can cross over those. And it's not like income taxes where you cross over by $20,000, you're going to pay just the additional tax on the $20,000. You cross over $1, you get the whole full increase of the Medicare premium adjustment. So I have one client who worked really hard in her early life, worked a couple of different jobs. She has so much in her pension and her Social Security and her required minimum distributions that we can't give enough money away. She's going to hit the highest tier, and she basically pays about $500,000, or not $500 for her Medicare premium, where most people are paying like $175. So it is a strategic planning piece that you do want to pay attention to. It is something that you don't want to have catch you. And that is where the challenge is. This is a 2-year lag. So you have to do something, plan your day, plan your year this year to circumvent a problem 2 years down the road. And that's not always where the focus is. And if you happen to have a higher income tax bracket, you probably have a IRMA issue. So sharing is caring. And another way you can share is with a charitable gift annuity, and to make a charitable contribution in a tax efficient way. That allows you, it creates an agreement between the donor, a qualifying charity, and an annuity contract. So what you're doing is the Secure Act expanded what you could do from your IRA accounts and said, okay, you're now allowed to make a one-time contribution of up to $50,000 to an IRA into a charitable gift annuity, from an IRA to the charitable gift annuity. That in turn, the annuity will pay the donor a monthly stream of income for life. And that can be set to cover both spouses, but it can only cover spouses. It cannot be, you can't include a child or somebody else in that income stream. It is only for the IRA owner and a spouse. And the donor begins receiving payments within 1 year from the donation date. And the charity then receives the remainder of the annuity at the time of the donor's death. So this has been a popular approach. The sad part is it's a 50,000 restriction of what you can take out of the IRA, and it's one time. It is not each year. It is a one-time contribution. Whether that will get expanded, we'll wait and see. But does give some charities a potential of monies coming down the road, a commitment that they will see. Who knows? Some people live long and some people are short. So the charity is just waiting for the receipt of the value of the remainder. Okay. So at this point, are there any questions?
So Peggy, can you talk a little bit about how, if you were to donate an asset in the form of a stock or investment, how does that work? If somebody wanted to donate an appreciated stock, who do they call? Is it their broker? Like, how does that work?
It's a couple of steps that you need to do. Most charities, the big charities, will have a brokerage account set up to be able to take receipt. Then you need to designate what is the stock that you want to transfer, and then talk with your brokerage or your advisor and say you want to donate this particular stock and this number of shares to this organization, and you get that organization will provide you with their brokerage information. So they do that, and then you get the value on the transfer date. The value of the stock at the transfer date is the value that you get for your donation. The stock gets transferred in what they call an ACAT. It's an electronic movement of these shares are in this account, and now these shares are in the charity account. Then the charity typically sells right away and then takes the cash and puts that into their program operations.
I have a question, Peggy, about evaluating the charities. If you could expand a little bit more about that. When you spoke to the one charity that was 95% of the donation went, I'm believing, back into the program or to service the program. And that was a good number, and 75 was a bad number. Is there a threshold that you're looking at when you're evaluating them? Like if they're over 80%, they're good, or 85, or could you speak a little more to that?
Part of it is how big they are, and I don't want to use names. And this particular situation I was evaluating, it was a very large organization. They had the ability to be running lean and mean. And so I was not happy to see that so much of their monies were going into their operations and not into their programs. They later came out and there were some issues that came out in the news that there were some issues on meetings that they were holding. Their annual planning sessions were a little bit on the frivolous side. And they took some heat because it wasn't all going to the veterans as it needed to have been. So if you're a smaller organization, like some of the charities I support here locally, you can't do 95% into the program because you have operations cost. You have to pay your staff, you have to pay your facilities, you have to pay your utilities. I mean, there's some basic expenses you aren't going to get around, but paying your office facility is a overhead expense. Paying housing facilities is a program expense. So it is taking a look at where their expenses are, and you really want about 80% or more going into the programs. And it's not a one size fits all. It really depends upon the size of the charity and what is getting spent for administration costs, because you don't really need to be supporting a huge director fee.
Got it.
So you want to keep it more realistic. Or in some cases, looking at some of the organizations, they're not paying enough for their staff. And if you want to keep quality people, you got to pay more for that. So that might push their numbers up higher in the program, in the operations, and less in the program. But if you want to keep a viable program going, you got to have quality staff.
Got it. Thank you. Shane, did you have something you wanted to say? Anybody else?
Just that I love Peggy. I'm freaking writing note after note after note. I learned a lot today. I believe, it is get better to give than receive. But honestly, I woke up this morning, I opened up my word and I read Proverbs right there. The first verse I read was that today. And I was like, well, Lord, you're trying to bash me on the head. I hear you. Thank
Well,
you.
I just was so thrilled that there's so much truth in that word that it crosses cultures and crosses income levels. It's the way we're wired. So you can benefit from being generous, but it's kind of like exercising. It works better the more you do it.
It's true. I always tell people this, you go back and think about all the gifts you've ever received. You might remember a few. Think about, there's a few things that stick out, but think about something you worked hard and you gave. Think about things you tried to give somebody and you really thought about it and you want to give them something. You can remember what you gave a whole lot more than what you ever got. That's just the way we're wired, like you said. Anyway, thank you. I thought it was
Yeah.
awesome.
Yeah. Yeah. Well, if you have individual questions or case situations that you would like to know, well, how would this impact me or how would this impact a client? That's what I do. It's a chess game. And while I don't play chess very well, I do play this part of the game really well. It's my passion to be strategic in my giving and intentional in my giving. And I like to hang out with people that are generous and give because, iron sharpens iron.
So
Very well
Peggy, a
said.
question for you. I think I run across people who will say, I don't make enough money to be able to plan for this kind of giving. I would just like your thoughts on that. Like, how would you respond to that? And at what point does this kind of planning make sense for people financially?
If you have any retirement monies, if you have any life insurance monies, that requires you should be doing something, have a minimum designating your beneficiaries on those items. You don't have to necessarily go get an estate planning attorney and say, hey, I want to do this elaborate plan. You just need to take a look at what are the assets that you have and how do you want to distribute them. In your lifetime, you have control of that and you can make those things work, like the stock transfers. But IRAs and retirement accounts have beneficiary designations. So you can put a charity on your IRA account or your 401k account or your 403b. You can do that without having to talk to an attorney. Or your life insurance, if you want to give that to charities or a portion of it to charities, or if you want to give all of your retirement monies to charities and leave a life insurance policy to the family or the kids, whatever you want to do. Those are not, again, you're just deciding who the beneficiary is going to be. And if you have an IRA or for retirement account, or you have a life insurance policy, you have something that you need to be very specific with how you did that. Why did you create those accounts in the first place? What is your intention for them? And then evaluate what you're doing and how you're doing. I I had a word of the year about 3 or 4 years back, and it was intentional. And it was to make me think about what I'm doing as I'm going through my day to make sure that those are the things I really needed to be doing. Well, it has permeated my life in that I really have become very intentional about everything that I am doing. To the point that some of the places where I volunteer have said, yeah, you're very intentional in what you give and where you give it and how you give it. But I think as you get older and you realize that you don't have forever, that you do get more intentional.
Absolutely.
Okay.
I think that was wonderful, Peggy. I know all of us got a lot out of that. We so appreciate you being able to hop on today and share your wealth of knowledge and your heart and passion of how you feel about this. I think it came through to everyone. We greatly appreciate that.
Great. Thank you.
If anybody has any questions, you can reach out to Peggy directly.